Hi, and welcome to the second video for the week one. In this video, we will try to discuss about what is a different accounting framework, which is implemented in Australia. So before I start the lecture, I'd like to discuss about how this series of the video will be consist of. So week number one, which I already cover, is your financial reporting framework and regulatory bodies. Next week, I will discuss about what is accounting theories. For this, I already upload the video. Feel free to watch it. Then for week three and week four, we will do the cash flow statement and the lease account. I talk about your midterm will be depending on these first 3 weeks. So week number one, week number two, and week number three, but not including the week number four. So I'm skipping the lease accounting for your midterm, but for the midterm is your first 2 weeks plus cash flow statement. And after second forum, that will be week 5, you will have your midterm. Then week number 5 to 8 and week number 11, that I will do some biological assets, intangible. Intangible is quite same like other tangible accounts, and then revenue recognition, very important standard. Today, we also discussed a little bit about what is the revenue recognition, and then EPS, earning per share, and segment reporting. After the midterm break, we will start the financial instrument. Financial instrument is the most heavy topic in this module. It will take kind of like 1.5 weeks to cover. But a part of this financial instrument is a foreign transaction, which we'll also cover over week 9 and week 10. So this is the procedure I will implement, or this is the way I will do. I definitely like to have your feedback in the classroom if you want to change around the things, but I already prepared for your first 4 weeks. Already the videos are ready. I will upload week by week because I need a lot of editing before I post the video over there. So every week I will post one video relating to the lecture, and my video will not be like 1 hour. It will be like 15 minutes, half hour, 20 minutes, kind of like chunk videos. So this is my plan for the upcoming weeks or for the whole semester. Okay, so we'll discuss about chapter number 2. It's about the conceptual framework for the financial reporting that was released back in 2019. The object of this lecture is to understand what is the general purpose financial reportings, what is the qualitative characteristics, not quantitative. The qualitative characteristics of the financial information we provide to the users. What is the concept of materiality, like whether the information is material or not. Be able to define different concepts of the accounting, financial accounting, like what we call assets, liability, expenses, income, revenue, how we define them, how we measure them. So it's a little bit apart from chapter number 4, which I have added in these objects of the lecture. So what is a general purpose financial statements and financial entities? So general purpose financial statement, I think you already know about what is statement of financial position, changes in equity, our cash flow statement, our disclosures. So these are the few general purpose statements which reporting entity has to report them. There are 5 in number, but most of the companies which are listed, especially, they need to report all these general purpose financial statements. Why they do it? Because they have some users of it. We call it stakeholder for this, like the people who borrow you the loan, lender, who is investing in your company, existing investors, and other creditor, even your employee. They are all very interested in the general purpose financial statement. So what are the different qualitative characteristics of this general purpose financial statement? So 2 words, which is very important, that is a relevance and faithful representation. So these are the 2 fundamental concepts. Relevance means the information you provided in your general purpose financial statements must be relevant to the user. For example, if a company provide balance sheet or a statement of financial position, and instead of writing assets, liability, or equity, they talk about maybe social responsibilities, which is quite irrelevant in that portion, because investors want to see what is of your financial position health. So according to that financial position health, they will invest in your company. Second thing, Maybe they provide you the right information that which is relevant to you, but it's not accurately or faithfully representative, you know. So maybe there's some typo error, maybe there's a material fault, so they don't want you to have this information to be disclosed. So that's a wrong information, although relevant to you. So these two concepts go hand by hand, and the general purpose financial statement should be representative like this. So it should be faithful and it should be relevant to the user. So upcoming few slides, you can read the slides through. They talk about what is the relevance. It should tie up with the concept of material, means if the information is material, it's always relevant. So materiality is very much important for providing an information. And faithful representation should have three characteristics: that it should be complete, it should be natural, and it should be free from any typo error. So this we already discussed. So you can read the slides through. I believe that you can read better slides than me. So now they talk about balancing relevance and faithfulness. Yeah, maybe you provide them a relevant information, but it was entirely wrong, means unfaithful. And maybe the information is correct, but not relevant to the user. So these two things should go hand by hand. There should be equilibrium in these two. So both information, whatever the information provided in general purpose financial statement, should be equally relevant and should be equally faithful, means right, correct. There should be no potential loss in it. There should be no potential mistake in it. Then they talk about the elements of the financial accounting statements, like they are assets, liability, equity, expenses, and income. In the upcoming slides, what we do, we try to define it, all these 5 elements. We discussed like when we're going to recognize it, how we're going to measure it, when we're going to present it and disclose it. So I think we already discussed if in financial accounting 2 or financial accounting 1, if you never have these definitions, you can have a recall of this in the upcoming slides. So what is the assets? Assets should be defined by 3 characteristics. Like future economic benefit should be there. If you have an asset, your company should control it, and control must be occur. So the transaction must already been done. So for example, there was a ACCA examination paper where I remember when I was solving that question, they say that there is an asset whose value is $2 million, I think, and 2 million pound. Yeah, 2 million pound, I think. And then they say everything is decided, the company has the control. However, they are unable to define how much discount they're going to get. So the problem with this is that they cannot measure the cost of the asset unless the discount is clear. So although it fulfilled all the criteria of being asset, but it wasn't recognized as an asset. So because discount cannot be measured. So if the discount cannot be measured, so you need to measure the cost of that value of the asset. So you can't measure the cost. If you can't measure the cost, it cannot be your asset, although it fulfills the other criteria. So remember, whenever you're reading any standard, be very specific about this and or are. So or means like one of those, and means both of the conditions should be fulfilled. So no, in that question of the 2 million pound, the cost can be measured. The cost cannot be measured, so that's why you cannot identify that as an asset. Then we have a liability. The definition of the liability is that there's a future obligation by the company to be paid. Company can get sued if they do not pay that money. So it is important to understand there is a legal enforcement. So this liability will eventually decrease the asset's value or reduce the value from the equity. So this is the definition basically for the liability. Now they talk about like what is the difference between the contingent liability and the liability. So contingent liability, so first of all, liability, the moment it occur or incurred and you have to pay, it is recognized in your books. We record that immediately. The entry for the liability is done on the immediate basis the moment it is incurred and is actually realized. Whereas the contingent liability is something which may or may not you have to pay, but you have to disclose it at least. You don't need to write down in your books immediately, depending on how much, what is the percentage of the probability of happening that event. So for example, there is an event that a company is under a lawsuit and its probability is less than 5%, which we call it remote probability. Maybe we did not disclose that, but if the liability increase like 10%, then we have to tell our shareholders that, hey, we are under a heavy suit and we need to pay back. And maybe we will lose this suit. So this percentage of winning that case or losing that case, depending on your opinion, on your lawyer expert opinion. So if you give you a different opinion or percentage, you will have to disclose that. Although you haven't paid for that lawsuit, although the case is still pending in the court, but you have to disclose because your lawyer say maybe after 1 year we will lose this case. So that's a contingent. That's depending on whether you win a case or lose a case. That's contingent on that. So you have to disclose about that. So that's the difference between a contingent liability and the liability. Then expense definition is basically a combination of an asset and a liability definition. Expense can either, in future that will be a decrease in economic benefit, or it, and the second definition which they take from the liability, it's the occurrence of the liability. That's decrease in the equity. So whether it will be a decrease in the equity or decrease in the assets. So continuing that definition of expenses, it decreases the future economic benefit or it increase the liability. So this is how you define the expense. Income and revenue, they are the two different concepts of income and the revenue. Again, we take the definition of the assets and the liability. Income is the one which helps you to increase the economic benefit of the accounting period. Whereas the liability, on the liability side of the income, we can say it is kind of like decreasing the liability in future. So either you decrease the liability in future or increase your assets. So it's your income. Now, there's always a confusion between the students regarding the definition of revenue and gain. So students never understand, they take these two words simultaneously, but it's not the same. Revenue is the one which company is doing the operations in. For example, if the company is manufacturing these t-shirts and they are selling these t-shirts, so those sales is revenue. Whereas, for example, that same company has an asset, a machinery, which is kind of get totally depreciated, and they want to sell that machine. So the company can put that asset on the sale. So the benefit or the gain they get for selling that machine will be your gain. Now, it is very noteworthy. The company initial benefit or initial business is not to sell the machines, is to sell the t-shirts. So company don't sell the machine on the daily basis, but it sells the t-shirts on a daily basis because this is how their operations are done. So that's the difference between the gain and the revenue. Gain coming on randomly selling a machine and getting a benefit on that. Revenue is your income, which you get from the sales. So that's the basically two differences between the gain and the revenue. So in the end, the last one is the equity. Equity is basically, they don't have its own definition. It's a residual value. Means if you have assets, less liability is equal to equity. So it's a residual interest on the assets after deducting all the liabilities. So this is basically the formula we use for determining the definition for equity. And there is no separate recognition for equity. Equity is basically the balance after you recognize all the assets and all the liabilities. So the difference in between them is the equity. So there is no separate recognition criteria for the equity. Now, there are a few measurement principles which we apply throughout the accounting standards, which is basically the foundation of the board. Basically, what IASB board favors that different assets should be recognized differently and their category differ from one to another. Like, for example, if you buy a machine and you buy a property, which is a fixed asset, should be recognized separately as current assets, which is which is receivable. So there's a difference in category of the assets. Ones are short-term, ones are long-term. So because of their magnitude is different, so their recognition is different as well. So the question which arises from this discussion is that, Should we have a different measurement basis for different class of assets and liability, like short-term liability versus long-term, or the short-term assets versus long-term, or tangible assets versus intangible assets? So our contingent liability versus the liability, should we have our different measurements for that? So this is a question, I leave it to you. We'll discuss that in the tutorial. Now, next is the critical review of the conceptual framework. Critical review of the conceptual framework kind of arises many questions, which has been addressed until now. Like they kind of are issue, there are the social issues which is missing in this framework. So nowadays you will heard about ESG, that is environmental, social, and governance issues. So our old financial statement, they provide the governance framework, like who is the board of directors, whether the CEO is also holding the office of chairman, how many independent director, what is the percentage of independent director is available. However, they did not discuss about social and the environment. So we are moving towards the sustainability reporting or integrated reporting. So therefore, these two issues have to be discussed. So these are the few basic concepts which are missing in the framework. However, now Australia has decided until 2030, every company needs to have an integrated reporting. What integrated reporting means that the company has to indulge or combine all the ESG concepts in their financial reports. Even Bursa Malaysia also start implementing the integrated reporting, where the company has to disclose what is the scope 1, scope 2, or scope 3 emission, carbon emission done by every company. Now, every company, even right now, if you look for a job, and you will find they require some managers who can do sustainability reporting. So we are moving towards a reporting where the company has to disclose what is their contribution towards the society, how much they are contributing towards the environment, how much they are contributing towards the betterment of the governance and the people. So these are the few things which were missing in that framework, but slowly but surely we are moving towards the ESG concept. So this is the last slide for the lecture. In the slide, they discuss about that, yeah, the framework do provide a very good framework for the financial reports or the performance of the company. Like you can see what is their ROA, ROE, and few, but they never discuss about what is the social and environmental performance. So this is very much important and must be integrated into one. Second thing they discuss about that financial reports actually present the financial indicators like the one I discussed, ROA, ROE, EPS, or the Timbix-Q, or the EPE ratios to show that how much company is successful. Again, they ignored the fact of the social and environmental factor. In the last, they discussed that, okay, there are many critiques, but there are few things which is very pleasant for this reporting standard. So this indicator basically helped them to show that how the company is doing and how they are improving their financial reporting patterns. Also, it will help the accounting professional to follow up this framework and to assess the company financial reporting standards. So that's pretty much it from this lecture. I hope to see you in the class next week. Take care. Bye-bye.